let's talk about changes in accounting policy. So an entity have adopted an accounting policy and then I've selected it to use for the preparation of the financial statement. What if there is a change in accounting policy? But we are saying that once an accounting policy is adopted, an entity will have to use it consistently over time. But when changes comes with these exceptions. When, for example, let's say, for instance, when there is a change in how the standard treats the event or the transaction, or there is a change in the interpretation of how the standard accounts for such event or such transaction, then there should be a change in the accounting policy. We call this change what? A compulsory change. A compulsory change. Where there is what? A change in the standard or the interpretation of the standard, then such policies should also have to reflect the change so that we can then have what? The transaction to be treated as per the change or the interpretation of what? Such standard. So this is what we call the compulsory change. But if the change will also lead to a more reliable and relevant information to users of the financial statement, then we'll have to do the change. And such change is also called what? An optional change. We can call it an optional change or voluntary change. Voluntary what? Change. Voluntary change. So that is the exceptions when it comes to changes in accounting policy, right? Where there is a change in the standard or how the interpretation of the standard are being used in the treatment of the event or transaction. If it change, then you have to change the accounting policy. Or if the change will lead to a more reliable and relevant information that will make users to be able to make wise economic decisions as per the financial statement, then there should be that change in that line. And that will lead us to what we call the changes in accounting policy. The next question we have to ask ourselves then is that if there is a change in accounting policy, then how should it be applied? So let's talk about the application of the policy, the application of the change in policy. So application of changes in accounting policy. Accounting policy. So we are saying that where there is a change in accounting policy, then such change will have to be applied what we call what? Retrospectively. Retrospectively. That means that the change should be applied to the previous financial statement and to the current financial statement. The previous financial statement and the current financial statement, even in the future financial statement. That is what we mean by what? The application of what? A changes in the accounting policy supposed to be applied retrospectively. But the big question one will have to ask him or herself is that if we don't have the previous, say, 10 years financial statement available, how then should the change be applied? The standard says that if we don't have such previous information, then the change should be applied to the earliest time possible. The change should be applied to earliest time possible. But where the earliest time possible is also not practicable, then the change should be applied progressively. That is from the date of the change. That's where you're supposed to have the change to be applicable. So that is the change in accounting policy when it comes to its application. So at any time an accounting policy changes, it has to be applied retrospectively. That is in the past financial statements, now and then in the future. So that is what we call a retrospective change when it comes to the accounting policy. So that is all about an accounting policy, changes in accounting policy, and its application, retrospective change. Now let's talk about the next thing we want to discuss. Let's talk about the changes in accounting estimates. Changes in accounting estimate. Changes in accounting estimate. So changes in accounting policy. What then is the meaning of changes in accounting policy? If you remember, in my introductory discussion under this standard, we said that as part of the preparation of the financial statement, management do make an estimate when it comes to the preparation of the financial statement, right? And that's where we are heading towards. So what then is the changes in accounting estimates? So when we say changes in accounting estimates, it's very simple. Here we are talking about what? The adjustment of the carrying amount of an asset or a liability as a result of the reassessment of its economic benefit or the obligation. That's what we call what? A changes in accounting what? Estimate. So here, now, let's say we have the PPE. Let's say the carrying amount of PPE is, say, at first when we bought it, let's say it was 2,000 what? Ghana cedis. Now we have used it for about 2 years, and now we have PPE being its carrying amount, right? The carrying amount to be equal to, say, 1,500. So we have reassessed and realized that now we have PPE to be 2,000, and now after 2 years we have its carrying amount to what? 1,500. What is then accounting for this difference? This is where the estimate comes in. We have what we call what? Depreciation. We have what we call depreciation. So depreciation is what? An accounting estimate. It's an accounting estimate. So here, accounting estimates, there are those what estimate that has been made by management as part of the preparation of the financial statement. So estimates like we may have what we call bad debt as an estimate. So we may have, for example, bad debt as an estimate. We may have depreciation. We may have what? Inventory obsolescence, and then the likes. We can also even talk about the fair value. The fair value of what? An asset. The fair value of an asset or a liability in that way. So all these are what we call what? A changes in what? An accounting estimate or an estimate. An estimate. Okay, so if an estimate is being what? Adopted or is being made by management, then the big question we ask ourselves is that if there is a change in accounting estimate, how the change should take effect? When we have a change in accounting policy, how should the change take effect? So let's talk about the change in accounting estimates and its application. Changes in accounting estimate and its application. So when it comes to the accounting estimate and its application, we are saying that when there is a change in accounting word estimate, it's supposed to be applied what? Prospectively. We are talking about prospectively, or progressively, or progressively. So when there's a change in accounting estimate, it's supposed to be applied progressively. It means that it's supposed to be applied now and even to the future what? Financial statement. So all these things that you see here, bad debt, depreciation, fair value of an asset or liability, they're all based on estimate. Let's say for a particular year, we had a depreciation of an item of PPE to be 10%. That was, let's say, in the year 2023, we had depreciation of 10% for PPE. But for, let's say, in the year 2024, management realized that the depreciation charge is supposed to be what? 15% for 2024. This, as an estimate, will only apply in 2024. 15% here will only apply in 2024 and then beyond. But for the 10%, only applied in what? Just 2023. So this is what we call what? An accounting estimate. It is what? Just, a temporal estimate that's been made by what? Management, which is applied prospectively, now and in the future. It doesn't apply retrospectively. So let's take note of that. So that's what we call what? An accounting or estimate. Now let's discuss the last part of the accounting policy, changes in accounting policy, and then errors, which is the errors in here. So when you say errors or error, generally it's a mistake. When we say error, we are talking about mistakes that are made in the books of the account. Something is what? Unintended. So here there's a difference between an error and a fraud. Error is something that you have committed, you didn't plan of it. Just by oversight or something of that. But fraud cannot be an error. Fraud is something intentional that you intend to dupe somebody to get, a gain or financial assistance of that, something of that sort. But error is an unintentional act that's being committed when it comes to the preparation of the financial statement. So when an error is committed, then we are saying that once it's committed, it must be corrected or immediately. Once an error is committed, it must be corrected immediately. So that is how the errors comes in. When it comes errors to here, we apply what we call what? A retrospective approach. When the error is committed, we apply what we call a retrospective approach. So if the error affects the current financial statement and the previous ones, you must go back and then reinstate what? The figures and then correct it, and then you have what? An adjusted, financial statement. But one of these errors that are very champion when it comes to the errors, what we call trial period errors. So we have trial period errors. Trial period what? Errors. So what are trial period errors? We are saying that these are errors which are committed in one or more, previous what? Yes, which must be what? Corrected by applying what we call what? A retrospective what? Effect, so that it will take effect in a previous financial statement and then that of the current financial statement. Because generally, these are what we call trial period or errors. They are omission from or misstatement in the financial statement when an information became available, which as a result of maybe an oversight or something of that sort, the entity could not be able to use it, right, as part of the preparation of the financial statement. So omission from or misstatement in the financial statement, which have occurred in the prior years or in the previous years, which must be corrected using the retrospective application. So that is prior period errors. And that is all about the IAS 8 accounting policies, changes in accounting estimates, and then errors. So thank you for watching. So in our next section, we are going to continue with the standards by looking out for what we call IAS 20, accounting for government grants and disclosure of government assistance. So thank you. Today is your first time on the channel. Do all to hit the like button and share and subscribe so that you don't miss out any updates we're going to upload on this channel. I'll see you. Bye.